Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. Markets in India were closed yesterday due to Dashera, but the updates don't stop. The risk assets did not seem to be in a celebratory mood, with some selling observed in global equities. Oil is another factor which is important for a country like India. We had OPEC Plus meeting deciding to cut oil production by 2 million barrels per day on Wednesday. This has led to some recovery in oil prices. We also had a few important data releases, including the jobs report, which JK will be covering in detail. Morning, JK. Jobs report did see some weakness in the available job openings. We saw a good dip in dollar index. How are you reading all the updates that have come in from all the way from oil to the data from US? And amidst all this, rupee seems to be somewhat resilient. Take us through your thoughts.
Hey, good morning. Yes, while we were closed for a day, we have had a fair bit of action and also news on the global markets, keeping the market volatility intact. In the last 2 days, we had two central bank rate decisions. Australia hiked the rate by 0.25% as against a wider expectation of a 0.5% hike, which many started to interpret as the beginning of central bank put going. I mean, looking at the way financial conditions were tightening, but the very next day, Reserve Bank of New Zealand stuck to market expectation of 0.5% hike, and there has been low let up in hawkish talk by Fed members as well. So more synchronized dovish tilt among major central banks is nowhere near. And in fact, the main surprise was the revelation that RBNZ had actually debated a 0.75% hike on the basis that this might reduce the expected peak in the overnight, overnight rate before settling on 50 basis points more. On the economic data front, as you said, yes, we had a job opening data which showed lower, but if you look at many other components of employment that were declared, it was all strong. Job opening itself, the Jobs data which showed job openings falling by 1 million, but the ADP jobs report, which was published yesterday, showed a higher number than 2 lakhs additional jobs created. We also had the ISM services data, which was published yesterday from US, and it came quite strong. In contrast to the ISM manufacturing that was weak, read as weak, and hence the dollar had weakened. The employment component of ISM services also was quite strong. So all that pointed to US economy is still doing well, and now the focus actually shifts to two numbers. One is the weekly jobless claims today, and tomorrow's non-farm payroll report for the month of September. So it's not all unemployment has increased in the US. Definitely, we will have to wait for tomorrow's data to get the key indication. Meanwhile, the Eurozone PMI came at 20-month low of 48.1, and on the positive side, US monthly trade deficit numbers were better than last month. So there's a stark contrast that is seen between Eurozone and US as well. Yields were slightly lower on the basis of Jones data and ISM numbers, but again, they picked up yesterday after particularly after the OPEC decision and also the ISM services number. So US yields were actually been higher, dragging the other yields also towards the higher side. Hopes that the economy is maybe slowing enough to get central banks to step back from large hikes have taken a blow on Wednesday on several fronts. Then we had a combination of mixed economic data and corporate news helping US stock indices rally strongly in the last 3 days, with both S&P 500 and Nasdaq gaining 6%. A jolt higher in the index also came when Elon Musk said that he would proceed with his previously planned purchase of Twitter, and reportedly at the originally agreed price. So Twitter's share price rose 21%, big influence on the market, of course. But importantly, the major stock indices still trade in the bear territory, which is 20% below their peaks. Investors seem to be somewhat doing bargain hunting the important data that indicates is that the PE ratios are now near the historical mean of 15.9, down from around 22, which was ruling at before the beginning of this slide late last year. So interestingly, the dollar had two-way movement in the last 2 days. Euro touched a high of on almost parity yesterday, before sliding back, and then that was triggered by EBIC PMI data and also profit taking, and one being considered as a good area for medium term guys to sell the euro, because structurally the trend has not changed for the euro. GBP also came off after big rally. I mean, it's very surprising that after all the bad news, GBP had rallied as much as 10% from its low of 1.0382 to touch almost 1.15. So these are looking like would be some big resistance, and we need some big trigger for these levels to be broken. Pound's recovery was also pinned down to government's reversal of plan to scrap a cut to the top income tax rate from 45%, and also the fact that the chancellor is expected to bring forward his plan to unveil a medium-term fiscal statement, which was scheduled to be set out in November, but will be announced later this month. The fact that the government is responding to markets' concern is helping the UK currency and financial markets there. On the Asian side, Chinese yuan has seen further significant gains, trading as much as 3% stronger at one point of time, from a high of 7.25 to 7.01 yesterday. And yen continues to languish between 144 and 145. And after the most important development of OPEC hiking cutting production by as much as 2 million barrels per day, the commodity currencies have got a boost. Of course, it is not a good news neither for India, who is extremely dependent on imported oil, and also for the overall global inflation. And that is, even as people are expecting, and there are, influential voices globally asking central banks to slow down their rate hikes, and this is have probably come at a very bad time. But one relief was that one of the Saudi ministers pointed that the actual or the real cut may be only to the extent of 1 to 1.1 million per dollar. But definitely we are dependent on the cartel for how our inflation goes and how our cost of living is decided. On the Indian side, yes, there has been double whammy on the rupee because OPEC cut the production, so prices on the oil will be higher. Then we already had a trade deficit for September, the preliminary number showing more than 26 billion once again, and the ongoing news about bond inclusion of Indian paper in the global bond index, which now has a very uncertain time schedule. Nobody knows whether it will happen this year. So all that together, it is challenging environment for the rupee. I guess more work needs to be done by RBI to get the rupee on track. Possibly not just intervention, government and RBI will have to work towards getting in more flows to balance demand and supply. Just interestingly, the global foreign currency reserves itself have been falling at the fastest pace on record. In the last, 9 months, the reserves of the central banks all over the world have fallen as much as 1 trillion, and India is part of that, of course. And there also, the valuation revision downward as well as direct intervention to protect the currencies have been playing a part. Finally, not a good news from the World Trade Organization also, who downgraded both the international trade for the next year from 3.5 to 1% decrease, and also the global growth itself has been downgraded for the next year. So like it's a very mixed market that we are seeing. Nothing very positive as we start the day, but all hinges on how the dollar proceeds. I think we had some small relief, and as one of the Fed members daily said that the dollar's unabated rally and its effect on other economies is a matter of concern. So this is the first time I have heard any Fed member talking about the strength of the dollar. So mostly, or I can say gradually, view is emerging that Fed or the US authorities might do something about the strength of the dollar without changing their course on policy rate hikes. So let's hope for that. Thank you.
Thank you, JK. And very interesting to note that, in the beginning of the commentary, you mentioned that Australia hiked by 25 basis instead of 50. And it, public is at large expecting, it is like the beginning of the central bank put. And how it's very interesting to note how such narratives change, from public expecting very hawkish stance to some sort of slowdown in this hawkish stories as economies face liquidity challenges and economic slowdown. So, based on which narrative comes out stronger, market categorizes and moves based on those stories. Very, very fascinating. That's it from us today. Markets continue to be volatile as such new data points keep on emerging. So keep managing your risk. We'll see you all tomorrow. Thank you.